You've poured your heart and soul into building your business. Late nights, tough decisions, and years of sacrifice. But here's what most business owners don't realize until it's too late. When you go to sell or pass down your company, you could lose 30%, 40%, or even more of your life's work to taxes. It's not uncommon for owners to walk away with only half of what they thought they were going to get. And that single mistake can make the difference between a confident retirement and one filled with regret. The good news, there are strategies to avoid this outcome if you plan ahead. Hi, my name is Mark Wisniewski. I'm the president of Southern Incomes. For over 20 years, I've helped business owners and retirees create tax-smart exit strategies so they can keep more of what they built and turn it into a secure retirement. If you're a business owner thinking about retirement, whether you plan to sell, transfer, or just wind down your company, this video could save you hundreds of thousands or even millions in unnecessary taxes. If you find this helpful, don't forget to like and subscribe for more insights on tax planning and retirement strategies. 1. Why selling a business is a tax landmine. Most business owners assume that the hardest part of selling their company is finding the right buyer. Makes sense, right? But here's what catches many of them by surprise: the tax bill. Depending on how your deal is structured, Uncle Sam could take 20% in federal capital gains tax, add in another 3.8% tax for net interest income tax. And if you live in a high tax state, may as well go ahead and add on another 8 to 13% more that'll vanish in state taxes. And don't stop there, because if your sale involves inventory, equipment, or even consulting fees, those can be taxed as ordinary income at rates up to 37%. Here's a quick example. A couple sells their successful manufacturing business for $7 million. After federal and state taxes, their net proceeds shrink to $4.2 million. They thought they were set for life, but suddenly they're second-guessing whether their retirement income will even last. The key takeaway: taxes can be the biggest expense in retirement if you don't plan ahead. 2. Start exit planning years, not months in advance. Here's what I tell every business owner I work with. If you're planning to sell next year, you're already behind. Most tax saving strategies require 3, and even better yet, 5 years of lead time to implement. Why? Well, you may need to restructure your company to qualify for certain tax breaks. You might want to gift shares to family members to reduce estate taxes. Or you could use those years to smooth out your income and avoid spiking into higher tax brackets later in life. Think of it like selling your house. You wouldn't wait until a week before your closing to go fix the roof or stage a home. The earlier you prepare, the more control you have. 3. Spread the tax burden with installment sales. One of the powerful ways to manage taxes is with installment sales. Instead of taking one massive check up front, you structure a sale so you're paid over several years. Here's why that matters. It spreads out your taxable income, potentially keeping you in a lower tax bracket. It creates a predictable income stream for your retirement. For example, Jim sells his veterinarian clinic for $4 million. If he takes that entire amount out in 1 year, he's going to owe roughly $1.6 million in taxes. But if he structures the deal in a 10-year installment sale, he might cut his effective tax rate and save hundreds of thousands of dollars, all the while earning interest on that unpaid balance. A caution: installment sales are not risk-free. If the buyer defaults, you could be left chasing payments. That's why it's critical to secure the deal with collateral or use some type of escrow arrangement. 4. Use advanced tax deferral strategies for your business property. Do you own a building or a warehouse or land as part of your business? If so, selling it can trigger up large capital gains tax. But There are tools like the popular 1031 exchange that can help you defer those taxes by rolling the proceeds into another investment property. For example, a family sells their restaurant for $3 million, including the real estate. Using a 1031 exchange, they can reinvest in a commercial property managed by professionals. They defer their taxes and now enjoy passive rental income without the headaches of running a business. For retirees who don't want to deal with tenants, a Delaware Statutory Trust, or DST, can be an excellent option. DSTs allow you to exchange into institutional quality real estate and collect income without being a landlord. 5. Reduce or eliminate estate taxes with gifting strategies. If you're thinking about passing your business to children or even the grandchildren, you need to consider estate taxes. Without planning, your heirs could face a 40% estate tax bill on the value of your business. Advanced tools like the Grantor Retained Annuity Trust, or GRAT, Family Limited Partnerships, or FLP, can help you transfer ownership gradually while minimizing taxes and retaining control during your lifetime. For example, a couple uses a GRAT to transfer a family farm to their children. It can lock in today's value for estate tax purposes and let the future growth pass to the next generation tax-free. The result, the family keeps the farm and the IRS doesn't get nearly half of it. 6. Consider charitable planning for high-impact tax savings. If you have charitable goals, you can combine giving with tax efficiency. Charitable remainder trusts, or CRTs, allow you to sell business assets inside the trust without triggering immediate capital gains tax. Receive a lifetime income stream. Pass the remainder to a charity you care about. For example, a retired doctor sells her medical practice for $5 million. She places a portion of the proceeds into a CRT and avoids an immediate $1 million tax bill and receives a steady income for life, while supporting her favorite causes. Charitable planning isn't just about generosity, it's a smart way to align your wealth with your values and cut your tax bill all at the same time. 7. Build a trusted advisory team. Here's the bottom line. You cannot navigate this alone. Selling a business is one of the most complex financial events you'll ever experience. You need a team, and that team should include a CPA who understands business exit strategies and the tax planning that goes with it, an attorney who can structure the deal and protect your interests, a fiduciary financial advisor to create a retirement income plan with your proceeds. When these professionals work together, they can help you avoid these costly mistakes and uncover opportunities that you may not even know existed. It's not about finding some magic trick. It is about coordinating a smart, customized plan that fits your goals. You've spent decades building your business. You took the risk, made the sacrifices, and created something of real value. But exiting your company without a plan, that's where too many owners lose control. Instead of enjoying the fruits of their hard work, they end up watching nearly half of their life's work vanish with taxes. Here's one. We once showed an owner in transition how to save an estimated $450,000 in taxes for the current year. The owner procrastinated, and I happened to hear back from them, about 5 or 6 months later. The owner told me that they were paying a tax bill for, get this, $450,000. Smart, very successful, but too busy to plan and now worth $450,000 less. It doesn't have to be that way. The earlier you start planning, the more options you'll have to reduce your taxes, protect your wealth, and set yourself and your family up for the retirement that you've always envisioned. This is not about working harder. It is about making smarter moves now so you don't regret them later on. If you're a business owner thinking about retirement, or even if selling your company is 5 years down the road, the time to start planning is now. book a call with me using the link in the description. Let's talk about how to create an exit strategy that keeps more of your money in your pocket and less in the government's.